Hey everybody, today we're going to be doing another dividend analysis, and today we're going to be looking at Texas Instruments, or TXN. TXN, a large tech company that anyone who went to a public high school and sat in a math class should remember. And I wanted to do TXN because they had earnings yesterday, which while beating those expectations, the stock dropped rather sharply. So we're going to look and see if maybe this is something to pick up on a downturn with a dividend yield, some kind of play there, or if its fall was really worth it. So as usual, we'll start with the dividend yield. We're currently just over 2%. In general, that's right around average. The S&P is going to yield you a little below 2%, I believe, though it's been changing with how up and down the markets have been recently. But for a tech company, 2% is pretty good. Getting over 1% for a large blue chip tech company is pretty good in itself. Next, let's look at our dividend history. We can see that currently we're getting $1.02 per share. And we have history going all the way back to 2000, where we were only getting just over 2 cents a share. So in the last 21 years, this is a dividend increase in the thousands of percent. That is really good to see. What's also nice to see is that the dividend increases have been increasing themselves. We've gone from increasing by a penny to 4 cents, to back to a penny, up to 4 cents again, up to 7 cents, up to 12 cents, so on and so forth, up to now. That's really good to see if you're looking at dividend appreciation. They are consistently raising their dividend every year by a good amount in the recent past, and overall just raising it over the last 2 decades. What's really important here is that in this time frame of 2 decades, we've had 2 major, well, 2.5 if you count the tail end of the, dot-com crunch, but as we can see here, during that time, they weren't really raising the dividend, but once we got out of that and we had recovered from the dot-com bubble, the dividend started going up again. We have the 2008 credit crunch. They were still increasing their dividend, and last year during the pandemic cough, they were still raising their dividend. So there's a lot of strength there in their ability to increase their dividend. No cuts, no suspensions, nothing like that. So let's see if they can afford it. We can see that they paid $3.66 billion in dividends last year. Let's head over to our cash flow. We'll look at our last 4 quarters trailing, and we can see that over the last 4 quarters, they've done $6.34 billion, which is up a good 30%. No, more than that. 50% almost for the trailing 5 years. That's really good to see. And as we can see, it's been increasing over and over. We only had a small drop over the 2020 quarters of about $500 million, but they recovered that quickly. And if we go back 10 years, we can see that they've been steadily increasing their cash flow over time. That's very good to see. Next, let's check that free cash flow ratio. So we'll take that $3.66 billion and divide it by $6.34 billion, and that leads us at about 57%. That is well within our acceptable range, not in our ideal range of under 50%, but we are under 75%, so there's a little wiggle room here. If they were to, say, drop back down to the 2020 numbers or the 2019 numbers, they would still be able to pay that dividend. They'd still even have a little bit of room for a raise. Now, if they go back any further than that, you're going to start to get into that territory where dividend raises aren't going to be possible. However, with how their free cash flow has been increasing so steadily, that is probably on the not likely side, so that's something to keep in mind. Next, let's head over to the income. And over the trailing 4 quarters, we can see that their net income is about the same as their free cash flow, just a little different, but not by much. And we can do that ratio of income, and we can see that their dividend ratio for income is 54%, almost the same as our free cash flow. Again, within our acceptable range, not within our ideal range, but their income has been steadily increasing, as we can see, no drops over the last 10 years. So if this free cash flow and if this income trend continues, then you can expect those dividend increases to continue. If we keep seeing them add, $500 million in income and free cash flow a year, you're very likely going to see those 5 to 10, maybe 12 cent increases on your dividend each year. Not saying it's going to happen, but it's very likely if this trend continues. So how are they creating this income? How are they creating this cash flow? TXN, everyone knows them for their calculators. If you did have to take one of those high school math classes, But that actually only takes up a very small amount, about 5% of their business. The large part of their business is semiconductors, which have been in the news recently. Semiconductors are, well, used to make computers go, essentially. And there has been a semiconductor shortage, so to speak, over the last year and a half. So what does that mean for them? Not much, it seems, as even with the shortage, their numbers have been increasing. However, their outlook on that semiconductor shortage is kind of why that stock price took a dive yesterday. So one thing you have to know about semiconductors is semiconductors function like oil in a certain way, in that they are more controlled by geopolitics than they are by supply and demand. China makes a very large amount of the base parts that go into semiconductors. So when the US, the West, other countries have bad relations with China, semiconductors start to become harder and more expensive to produce. This is the same with oil, where when countries that produce oil start having problems with each other, oil prices start to go crazy. Same thing for semiconductors. There's always going to be supply and demand for the supply of semiconductors. That's never going to go away. Computers aren't going to stop existing unless a new technology emerges. So don't fall into the supply and demand trap for semiconductors. When you're looking at TXN, when you're looking to see where their stock price is going to go, you do want to look at that geopolitical space. You want to see, are these countries getting along? Are the different parts that go into making the semiconductors, are they able to get to where they need to go? That's what you really want to look at when you're looking at this company as an investment, even if it's not a dividend investment, just an investment in general. So, who is this company for? Should you be buying Texas Instruments? Does it fit your needs? From an income perspective, no, not really. You can do a lot better than 2%. You could just invest in the wide market, diversify yourself, and reduce risk at that point. However, as we saw from their dividend history, the increases have been very nice over the past roughly decade, especially over the last 5 years. 12 cents a year, very nice. You're going to get a lot of appreciation there. The only issue comes down to the price then. They're currently trading at about 31 times free cash flow, which is kind of rough for such a large, mature company. As we can see, a $170 billion company at about 30 times free cash flow is kind of expensive. So if this were me, I'd really be looking for that drop yesterday of 5%. I'd really like to see them drop another maybe 15 to 20%. However, if this is a long-term play and you just want a dollar cost average into it, you're very likely going to get those dividend increases, and they will be back at this price, barring, a scandal or some kind of thing like that. I don't see them, if there is a market crash and them dropping, I don't see them never making it back to this price. So if you wanted to dollar cost average in, that's a choice. The other problem that you could face here is that their stock price is a little prohibitive if you don't have a lot of capital. 183 bucks for a lot of people could be their entire investment for a week or a month, so keep that in mind. If you have a lot of capital to spend, this is fine. If, however, you're one of those people who can only afford to, DCA into a couple of $20 or $30 stocks every week or month, then you don't have to worry about missing out on this. You're probably not going to be missing a cash cow or anything, so don't worry about that. And I think that's about it, so I hope this helped, and thanks for watching.